Hey everyone, welcome to this explainer. Today we are putting Cintas straight under the microscope. We're going to act as your personal investment committee to figure out if this absolute A-plus business is actually worth its massive premium price tag. So if you love dissecting high-quality compounders, you are absolutely in the right place.
Real quick, here is our game plan for today. We'll start with a snapshot of the business, stress test it through the legendary investing lenses of Warren Buffett, Peter Lynch, and Benjamin Graham, run a discounted cash flow, check out some alternative models, and finally, deliver a definitive verdict.
All right, Section 1, Company Snapshot. Let's get right into what makes Cintas such a relentlessly consistent machine.
Trading right around $204 a share, Cintas is, honestly, a pretty unglamorous but brilliant compounding machine. What do they actually do? Well, they rent out uniforms, floor mats, and provide first aid and fire protection services to other businesses. The real magic here is in those highly sticky recurring contracts. A customer signs on, and a Cintas truck just shows up every single week, year after year. That creates what we call a route density moat, meaning once their truck is already in a neighborhood, adding one more customer on that route costs them almost nothing.
And that moat translates to serious dollars. Out of their recent $11.26 billion annual revenue, the core uniform rental segment totally anchors the business with $8.6 billion. But pay attention to their highly profitable cross-selling engine in first aid and safety. That adds another $2.6 billion. Think about it. The truck is already at the customer's door, right? So upselling a first aid kit or a fire extinguisher is just pure high-margin growth.
Okay, Section 2, the guru lenses. Let's see how the absolute masters of investing would grade this stock.
Starting with the Warren Buffett lens, Cintas is an absolute dream. You know Buffett looks for an economic moat, consistent earnings, and a really high return on equity. Well, Cintas boasts that phenomenal local route density moat we just talked about, plus a staggering 38.9% return on equity. That's huge. And when we look for owner earnings, which we know Buffett loves, they generated $1.88 billion in free cash flow this past year. Against a very manageable $2.4 billion in total debt, this company easily checks every single one of Buffett's qualitative boxes.
So it clears Buffett's hurdles and stands tall as a true stalwart in the market. But would a growth at a reasonable price legend like Peter Lynch actually pull the trigger and buy it?
To answer that, we have to confront a pretty glaring number. Cintas currently trades at a very rich price-to-earnings ratio of 41.64. For a company this size, you guys, that is a massive, massive premium.
Lynch relies heavily on the PEG ratio to figure out if he's overpaying for growth. So if we take that 41.64 PE multiple and divide it by their historical and projected 8 to 11% earnings growth rate, we get a PEG ratio somewhere around 4 to 5. Ideally, Lynch wants a PEG of 1. So yeah, this is a clear sell or avoid under Lynch's framework. The price tag is just way too high for the growth rate you're getting.
And Benjamin Graham's defensive checklist? It is even harsher. Graham demands a strict margin of safety. Now, Cintas does pass his tests for adequate size, strong financial condition, and earning stability. I mean, they've raised their dividend for decades, but it massively fails his rigid requirements for a moderate valuation. Graham wants a PE under 15 and a price to book under 1.5. Cintas is trading at over 41 times earnings and nearly 16 times book value. No way Graham touches that. Let's plug the numbers into Graham's famous intrinsic value formula just to see. We take their $5.14 billion in equity, divide that by 401 million shares, and we get a book value per share of $12.84. Running that through Graham's equation gives us a fair price of just $37.66, with the stock sitting over $200 today. Yeah, this offers absolutely zero margin of safety by Graham's strict standards. Moving on to Section 3, discounted cash flow. With the gurus flashing some serious valuation warning signs, let's step away from the formulas for a second and quantify exactly what the future cash flows of this business are worth to us today. We kick off our DCF by defining our owner earnings using Cintas's reported free cash flow of $1.88 billion. What's super interesting here is their underlying capital-light services model. Cintas only spent about 3.5% of its revenue on capital expenditures last year. They just consistently convert their robust earnings into hard cash, making projecting these flows incredibly reliable. When we actually run the discounted cash flow, blending a conservative 8% and an aggressive 11% growth path, and discounting those cash flows back at a weighted average cost of capital between 8 and 10%, we get a value range of $160 on the low end to $270 on the high end.
Probability weighting these scenarios lands our fair value right around $205. And what's the stock trading at? About 204. So our DCF essentially matches today's price. You're paying exactly fair value.
All right, Section 4, Alternative Valuation Models. Let's make sure we aren't missing the broader market context here.
Running a comparable multiple analysis reveals the core tension with this stock. We're looking at a massive 40 times forward earnings multiple up against the company's 8 to 10% growth rate. The bulls will argue that a 23% operating margin and a wide moat deserve a perpetual premium. But the bears, they argue this stock is priced for absolute perfection. At 40 times earnings, there is literally zero room for a stumble.
Based on recent guidance, the company is delivering solid workday-adjusted revenue growth of about 7 to 8.3% organically. But honestly, to sustain a 40 multiple, the bulls really need this growth to accelerate. This is exactly why Cintas makes moves like their pending $5.5 billion acquisition of UniFirst. They have to deploy capital and find cost synergies to drive earnings growth fast enough to justify this incredibly rich valuation over time.
Okay, Section 5, Synthesis and Final Verdict. We've run the numbers, consulted the gurus, and mapped out the cash flows. Time to bring all these conflicting signals together. Looking at our fair value summary, we get some vastly different perspectives. Graham's value-first formula thinks it's wildly overpriced at $37. Our discounted cash flow suggests it's perfectly fairly valued at $205. Meanwhile, Wall Street analysts, who usually lean a bit more optimistic on quality, have a consensus price target near $214. So here is the ultimate dilemma for our investment committee. How do we weigh a flawless, wide-moat compounder that has expanding 23% margins against the massive risk of a 41 times multiple? The business itself is an A+, the balance sheet is rock solid, the execution is flawless. But buying at a valuation that could severely derate on even a tiny macroeconomic wobble, or maybe an integration issue with UniFirst, that is a serious risk. Blending insights from Buffett's love of the moat, Lynch's warning on the PEG ratio, and our DCF modeling, our objective verdict is a reluctant hold. It is arguably one of the best-run companies in the whole market today, but disciplined value investors should really wait for a broad market pullback to the mid-170s before initiating a new position. If you already own it, the quality completely justifies holding it and letting it compound. We just wouldn't chase it here. I'll leave you with this final thought to consider for your own portfolio. In a market that is just completely obsessed with high-quality compounders, is the comfort of owning a near-flawless business ever worth the risk of buying in with absolutely no margin of safety? Thanks so much for joining this explainer. Keep doing your own research, and we'll see you next time.